Good evening, sir.
Yes, good evening, Anil. How are you?
Fine, fine. Absolutely.
Good evening, sir.
Good evening.
Good evening, Anil.
But I'll be there. और मैं बाहर हूँ 6 बजे आएगा 6 बजे वापस आए Twenty-three, 24, 24.
We are starting. Respected Speaker Shri Pinakin by Desai, Vice President Mir by Sheth, Joint Secretaries Kinjal Shah and Chirag Doshi, Treasurer Anand Bhatia, Chairman of Taxation Committee Shri Deepak Shah, Co-Chairman Shri Anil Satheji, past presidents, dignitaries, and all others assembled virtually. A very good evening to all. I welcome you all to the virtually assembled and one of the most sought after lecture of each year from BCAS to understand the intricacies of direct tax provisions of the finance bill. This year's budget has been projected to lay down the blueprint for the Amrit Kal of the next 25 years from India at 75 to India at 100. The budget has initiatives which are futuristic and heavily loaded with big public investment for modern infrastructure, readying for India at 100. On the macro front, the budget's focus has been on addressing the 4 priorities. First is PM Gati Shakti, second is inclusive development, third is productivity enhancement and investment, sunrise opportunities, energy transition and climate action, and finally, financing of investments. We are here today to listen to the masterly analysis of Chapter 3rd of the Finance Bill 2022, which deals with the changes of the Income Tax Act. The budget reiterates its aim to rationalize provisions of the Act, thereby reduce the scope for litigation. However, on reading it, seems that there are many changes which will impact not only corporates, but individual taxpayers too, and to a large extent, charitable institutions. We shall be given a holistic view of major provisions of Income Tax Act in his inimitable style by Pinakin, which we always eagerly await to listen. By the way, this is fourth consecutive year of analysis of direct tax provisions of finance bill by Pinakin. I would just highlight that BCS is the largest voluntary professional association of chartered accountants with its motto of disseminating knowledge and empowering small and medium practitioners. I strongly believe that if you have an urge to learn and share knowledge, then BCS is the most relevant forum for chartered accountants to be associated with. I urge you to visit our website and surf through the resources and events. This will provide glimpses of what is in store once you are part of BCS as a member. We are an 8,000 strong family and have ambitions to reach magical figure of 10,000, which can be achieved with support from learning enthusiasts like you all. I now request Shri Mihir Sheth to formally introduce Shri Pinakin. Thank you.
Thank you, Abhay. Shri Pinakin Desai is a member of the Institute of Chartered Accountants of India since 1973. He is also a partner in Ernst & Young and heads its Tax Knowledge and Solutions Group, that is KNS. The KNS is a dedicated team of tax professionals that provides technical support to the tax practice and is engaged in developing tax solutions and strategies. Before joining Ernst & Young India, Pinakin was a senior partner in PD Desai and Company. He was also associated with NM Raiji and Company, including as a partner in the firm for 8 years. Pinakin was a visiting professor in Narsimhanji College of Commerce and Economics, a leading college in Mumbai, for 8 years. In the year 1987-88, he was the president of BCS, Bombay Chartered Accountant Society, and was thereafter the chairman of International Taxation Committee of BCS for years. He was also the chairman of its taxation and other committees in the past. He has contributed a record of more than 30 technical papers at RRC, that's residential refresher courses of the BCS, on the subject of taxation. He was vice chairman of the taxation committee of the IMC, Indian Merchants Chamber, honorary treasurer of Forum of Free Enterprise, and independent director on the board of companies. Pinakin was a member of the editorial board of ICAI and other committees. Over the years, he has also presented various research papers at seminars and conferences of ICAI and many other professional and trade bodies on the various subjects of professional interest. It's honor as always to have you, sir. But before I request Pinakin to share his views on the finance bill, may I request you, Pinakin to release the budget booklet that BCS team of volunteers tirelessly worked to publish in 3 days of the budget presentation. So over to you, Pinakin for this grand release at your auspicious hands. Thank you.
Thank you, Pinakin.
The budget booklet is now available for distribution to all those who have booked in advance and is also available over the counter at BCS office on first come and first served basis. Thank you. Over to you, Pinakin We are all eager to have your views. Thank you.
Thank you very much, both of you, for very kind words. And may I share this platform on this auspicious day today, along with all of you here on the screen and off the screen. Let me start with some opening remarks or comments with regard to the finance bill. There were expectations from the finance ministry that he will be touching upon the roadmap to Pillar 2, and that was a very high expectation. People were waiting for that in order to adjust their tax technology as also the tax structures. But that didn't come. I believe, as we understand, the strategy is still being worked out. And maybe later in the year, we will have something coming from the finance ministry or CBDT on how to proceed further on Pillar 2. One single most noticeable feature of this finance bill can be the way in which some of the amendments have been carried out on a retrospective basis, including an area where we find that an impression of retrospectivity is given, though really speaking, it is not meant to be a retrospective amendment. That's a very innovative and a novel feature that we have in this budget. So on the point of retrospectivity, we can divide into three buckets. Number one, as in case of last year, we have a number of amendments which are made effective from 1st April 22. In my humble view, these amendments can also be considered as retrospective amendments to the extent they touch events and transactions which concluded before 1st of February 22. Second, contrary to the philosophy of the present government, we have one provision where there is retrospectivity dating back to assessment year 2005-06. This could be beginning of a trend, because once there is a slip, then in that case, it is a little flexible to follow the same slip, and the current amendment may be treated as a precedent in a subsequent year that yes, we also do carry out retrospective amendments. I think the government, at least in the context in which amendment is made, could have avoided making a retrospective amendment, and they could have lived up with their philosophy. The third, there are two amendments where amendments are really speaking prospective, but the language which has been used in the course of amendment is such that it will carry an impression in the mind, at least of the tax authorities who have to implement law, as if that the legislature has considered it to be retrospective. I don't think this would have been a very appropriate manner of doing it. A strong judge and a strong judge will, a strong tribunal member or a strong judge will certainly take a view that the amendment is prospective. Therefore, if I want to decide an appeal pertaining to assessment year, say 1920, I will merely read the text of the provision which prevailed in that particular assessment year. I will not read the current text and make additions and deletions in order to derive what the law in assessment year 1920 was. Probably the mind of the tax authorities down below will be swayed away by the language, which is not a very fair proposition. The last is, in an innocent-looking budget, we have a number of amendments, as the President mentioned. It would be impossible for us to consider everything, and maybe we may therefore have to restrict ourselves to about 10-12 amendments which are considered to be of general application. There are some amendments which appear to be catchy as such. Say, for example, the gift city related, or Section 14A related, or repetitive appeals related. But by and large, to some extent, they have become academic, or they may have a very limited application, and I do not propose to take up those amendments. Let's take up the first topic for the day today, and that is the change in tax rates. A very welcome provision of the budget, welcome aspect of the budget has been that the base rates of tax have not been changed at all. The changes are merely in the arena of surcharge on income tax. And there are two provisions which are of relevance here for the purpose of change in the surcharge levy. The first one, there are certain consortiums composed only of companies, and these consortiums are often taxed as association of persons. It's not a benchmark law or a rule that every consortium is automatically an AOP, but maybe there are certain taxpayers who willingly adopt themselves in the status of an AOP. Now, what could be the surcharge rate applicable to an AOP? When income exceeds 5 crore of rupees, surcharge right across goes up to 37%. But in case of an AOP composed only of the companies, we are told that the surcharge rate will now be 15%. This could be to offer a level playing field in as much as that the companies also will pay tax on dividend through the hands of the shareholders as and when the dividend is distributed. The second change that we find is a very important change. Until last year, while a taxpayer, being an individual having income above 5 crore, would pay tax of 37% on the whole of his income, there were exceptions. Namely, on the dividend income, he would pay tax of 15%. On the listed shares, long-term or short-term capital gain, he would pay surcharge of 15%. The base or the basket has now been expanded. Dividend will continue to bear surcharge of 15%. Listed shares, short-term or long-term, will continue to bear surcharge of 15%. But if there is any other long-term capital gain arising from any asset whatever, it could be either a residential house, or it could be a unicorn, or it could be an unlisted company. In each of the cases, but provided it is long-term capital gain, that surcharge would be 15%. Now, if supposing I have salary income, I pay surcharge of 37% in a high bracket. I also have, say, dividend income. For example, 3 crore of income, which is salary income, and 3 crore topping up is the dividend income. So we have a provision available to say that in the bottom layer, salary will be placed so that the benefit of the slab rate, which is lesser than 37%, would be available with regard to salary income. And thereafter, on the top of that would be the box of dividend income, where there will be controlled 15% surcharge rate. The second amendment we deal with is reimbursement compensation to victims of COVID-19. We already had a circular, a press note issued in June 21 to clarify that some of the payments received by the family of the victim will not be considered to be taxable, particularly under section 56 to 10, where any amount which is received without any consideration is considered to be income from other sources. Now, statutory recognition has been given to the press note, but with certain changes and certain clarifications. We are now told that, and I restrict only to one form of compensation, namely on demise, the compensation which is received. I'm not dealing with the reimbursement of medical expenses, etc. Now, on a demise, when a family receives anything from the erstwhile employer, on a limitless basis, the amount would be exempted, provided the amount is received by a member of the family. Second, what we find is that if amount is received from anyone other than the employer, then in the aggregate, 10 lakhs of rupees would be exempted. There could be some exceptional cases where it could be aggregate of 25 plus 10, in which case 35 would be exempted. Now, in a way, this is just a monetary compensation. You can't compensate for the agony that the family would have gone through. What we are now told in the statute is that exemption would be available provided amount has been received within 12 months or by 12 months from the date of demise. I personally feel that there should be reconsideration of this limit. It would be the best if it is limitless in the sense that anything which is announced during a particular period, because there are some employers who said that we will take care of the widow during her lifetime. We are told that education will be the responsibility of the employer throughout the graduation level uplift of the children, etc. But even if we don't do that, in the minimum, what we can do is that this limit of 12 months may be raised to 24 or 36 months. The reason for that is that we must acknowledge that when the family suffered at the employee level, the employers were also to an extent destabilized. They didn't know what their position is. Some of them were on the verge of closure, and they could assess themselves only after they had some peace of mind and they started considering how best to compensate the employees. So there could be some payments made by employers after they have rehabilitated themselves, and they might have made payment beyond 12 months from the date of demise. So there is a reason for extending the time limit. Second area where a reconsideration or a review is needed is that a member of family alone will qualify for exemption. A member of family is to be decided as per definition in section 10, subsection 5. Definition in section 56 is not taken, but the definition in section 10.5 is taken in order to apply it to the provisions of section 56 to 10. Now, this can have some results which are not easily palatable. Supposing there is demise of Mr. A, son of Mr. A is already predeceased. Therefore, compensation is either given to the spouse or is given to the grandchildren. None of the two qualifies as a member of the family within the meaning of section 10.5, and the exemption may be lost. Some employers may believe that even though son may be there, let the amount may be paid to the grandchildren, maybe by creating a trust so that the children are taken care of. Even in such a case, we will find that the amount may not qualify for exemption. Fairness demands that these cases may be reviewed. The third is the language. And in our law, in India particularly, we should be very mindful of the language which is used, because the taxpayer as also the tax authority, both of them are very rich litigants, and they raise litigation on the drop of a hat. What we are told is that the demise has to be on account of an illness which is related to COVID-19. Are we looking at a proximate connection? Are we looking at a relationship? There are quite a few cases where we find that A person came from the sickbed of COVID, was there in the house for a week or a month, but he had developed certain symptoms or incidental difficulties, and ultimately, maybe on account of a cardiac arrest or hemorrhage or whatever, we had a very unfortunate demise. Tax authority may come up and say that it's not on account of COVID-19. And the villain could be, as we read in the newspapers, I don't know for a fact, that COVID cases had to be reported to the government. There has been an allegation that the cases are not properly reported. So if one were to go by a report which is there with a municipal authority, it may or may not be the correct barometer of whether a person is or is not entitled to exemption. With this, may we shift to the third amendment, and that is a retrospective amendment taking effect from 2005-6, and it deals with deductibility as business expenditure of education cess or health cess. Maybe the stake involved on this amendment, entire nation put together, may not be very material, very alarming, but we are looking at whether this retrospective amendment should have been made, could have been avoided. We are aware in the provisions of section 36 and 37 that any amount which is in the nature of income tax payment by a taxpayer is not a deductible expenditure, and a very fair provision. Every country has it. Surcharge is being considered as part of income tax. Question arose whether a cess which is levied could clinically be considered as a component of income tax. Is it part and parcel of income tax, or could it be differentiated as something which has something to do with income tax but is not income tax proper? Courts had taken different views. Tax authority had a view and a valid view. Even we had gone by the same view until we started receiving a number of high court judgments where we found that the courts are not aligning with our view. Even today, I would believe that a negative view against the taxpayer probably is the correct view. Now, tax authority is in litigation, and the reasoning which has been given for the purpose of making this amendment is, namely that there is an old Supreme Court judgment in the case of Srinivasan, which is in 83 ITR, page 346, where the issue is already concluded according to the tax authority against the taxpayer. So they believe that every litigation which is emerging is an academic litigation. If the issue is closed by the Supreme Court judgment, then why should it be allowed to be litigated? I would believe that a more proper way, particularly if an item is covered by the Supreme Court judgment, would be that why worry? Ultimately, the tax authority will succeed. Maybe on an out-of-turn basis, the court could have been requested to take up the matter because it appears to be a covered matter. Let the court decide rather than probably set a precedent that since in my reading the matter is concluded, I will make a retrospective amendment. But given that an amendment is made, I think there will be some benefit which the taxpayers may have. When there is a demand which is arising on account of a retrospective amendment, we have circulars under section 119 to say that there could be waiver of interest which is payable by a taxpayer. If I had probably lost before the court, circular may or may not have applied. But here what we find is a retrospective amendment, which is what the tax authority will write in the order which is concluding. And therefore, there should be a coverage within the circular to apply for waiver of interest. Let me take up the fourth amendment, and that is a celebrated section, section 43B. What it provides is that certain categories of expenses are allowable, provided they are actually paid and they do not sit or remain a sum payable. If it is an outstanding liability, if it is a sum payable, then it is not likely to be allowed in certain cases. One of the cases is that if there is interest which is outstanding, which is payable, I'm repeating this because eventually when we dissect the amendment, this might become relevant to examine. If interest is payable and it is payable in favor of the public financial institutions, etc., then it will be paid only on an actual payment basis. There were cases where, as the Supreme Court eventually noted, in the case of Technology, namely that some of the lenders had converted the deferred interest, the outstanding interest, into a second loan. That was in the nature of an abuse, which the government wanted to plug. And Section 43B, therefore, has an explanation today, which is worded differently from the way in which the amendment is now sought to be worded. The explanation currently says that when there is conversion of outstanding interest into a loan or borrowing, then in that case, it will be considered, it will be deemed that it is not paid. In other words, as per the current language of law, even if somebody makes out a commercial case that this is a case of interest actually paid, the law will treat it that we will deem that it is not paid. So the deeming provision was effective enough to deem that an amount is not paid, no matter whether commercially you may argue that it is paid or not. Now, what was the development? Why did the amendment came into focus? In the case before Supreme Court, Technology, outstanding interest was converted into a debenture. And question arose whether explanation 3C, D or E is wide enough to cover a case where conversion is not into another loan, but conversion is into a debenture. And Supreme Court here took a view that look at the manner in which conversion has taken place. It's not as if that Supreme Court decided on the basis that debenture is not a loan, but they have gone further to analyze this to say that look at the way in which conversion has taken place. Debentures have been issued in lieu of interest. Interest, there is now a cessation of a liability. It is no more payable now. It is cessation of a liability. Recipient of income also has reported income in his assessment. Accounting books of both the parties are framed in a manner that there is no more sum payable by way of interest, and there is nothing receivable by the corresponding part as interest income. Now, in such cases, Now, in such cases, interest should be considered to have been actually paid, and therefore Section 43B will not apply. Indeed, debentures by nature will also be transferable, and there could be future cases where debentures may be listed as well. Now, in order to get over this, what is the language which is used? The language which is used is that if there is conversion into debenture by which liability is deferred, then in that case, under the new explanation, despite conversion into debenture, Section 43B will apply and interest will not be deductible as expenditure on actual payment basis. Probably this is not what they wanted to do. If this is what they want to do, I think it's very necessary and very nice that they have used a proper language. Because what this language would suggest is that if interest payment is deferred in the sense that interest is still not paid, there is a postponement of payment, but the liability is deferred. Whereas what the Supreme Court said is that this is not a case where liability is any more payable. It is settled. There is a cessation of a liability. And while the earlier deeming fiction in explanation 3C in the law today would create trouble for me, the new amendment which is made will mean that in a case parallel to the Supreme Court judgment, interest will still be deductible in the year of conversion into debenture is a proposition which I am trying to make out. Take the next amendment, a very, very debatable amendment. Over the years, lot of debate, lot of controversies, and trying to settle it in a manner which may appeal to some people, which may not appeal to some people. Expenditure which is incurred against public policy. The genesis of this explanation and this provision are the pharma companies and other companies in the health sector, including the diagnostic centers. The explanation says that if there is any expenditure which is incurred by me being a person computing business income, and if the purpose of that expenditure is an offense or the purpose is one which is prohibited by law, then the expenditure will not be allowed as deduction. Very strong words. Purpose should be an offense and purpose should be prohibited by some law. And people thought by law means by some law in force in India, because that's what we will call law. Over the years, litigation arose in what context? Pharma companies, the allegation is, are making payment to the doctors. Payments will be made for promoting the drugs. Payments will be made in variety of forms. Either that a particular doctor, you may find that painting of a doctor will be, the clinic of a doctor will be painted at the cost of the pharma company, or there will be sponsorship of a foreign tour. It could be a group of doctors, it could be an individual doctor, and a variety of other hospitality events will be organized for the doctors. Whenever these cases came up, to an extent, court started taking a view, namely that this is a section where the legislature believes that any expenditure which is against a public policy should be considered as not an allowable expenditure. Public policy in itself is a very wide term, a very ambiguous term, not appearing in the section, but that's how some of the courts had started looking at the matter. Pharma companies therefore put up a claim for deduction of expenditure. In defense, the tax authority would come up with a proposition, namely that look at the guidelines which govern the doctors from the medical associations, and the doctors are told that you cannot accept any hospitality on ethical grounds, on moral grounds from the pharma companies. So tax authority made a submission that if from the angle of a recipient, this is not a good proposition on ethical grounds, then it should be presumed that also from the perspective of a pharma company, the expenditure is not deductible. But rightly, the courts were trying to interpret that let's interpret a provision of law, because what matters is interpretation on the language of law and not on the basis of a particular prejudice which I may have or a particular thinking that I may have. And the courts therefore said that maybe the guidelines are relevant from the perspective of a doctor. Let the medical association take action against the doctor is a different thing. But in the assessment of a pharma company, the expenditure may still rank for allowance. There are cases against, there are cases in favor as well. There were some other cases. Say, for example, a pharma company. A dispute arose in an overseas jurisdiction whether there has been a patent infringement by a pharma company. Without admitting the guilt, pharma company may compound the proceedings and pay some damages. There was also a case where a pharma company received a certain amount from a person holding a patent. And I, being pharma company, was told that if I refrain from manufacturing a generic product which I have developed, then a patent one who is making ethical product will pay a certain compensation to me. This was considered, as per the European law in the European Union, to be an anti-competition default agreement. So I received, according to them, damages under an agreement where I am breaching a foreign law. If any such payment is made by a person in assessment to another person who has agreed to receive the compensation, should there be deduction of an expenditure? Favorable views were taken. In order to deal with all these cases, the amended law, which is as such prospective, but styled in a manner to create a magical impression as if it is retrospective, has been that an expense will not be allowed if it is an offense or prohibition under a law in India or outside. Second, if there is compounding, then the compounding amount also will not be considered to be an expenditure. And the third is that if a recipient of any such amount is bound by some regulation or some code or some etiquette under which he is forbidden from receiving that amount, then in the hands of the payer also, the amount will be considered as not being a deductible amount. Now, an altogether a separate debate could be, and this has been a debate right since the days of Mr. Palkhiwala, who are we to debate it, where he always used to say that why should income tax law be a conscience keeper that you consider whether an expenditure is from the angle of a man in business, an expenditure in business or not. What is stated always was that tax income, and income is to be determined from the perspective of a man in business. What a man in business will consider to be an income which is earned from business by him. Now we can't go back there, but what we find is that is the matter getting stretched a little far. There can be genuine cases where a pharma company or any other company would not know whether law is getting violated or not. Best of the lawyers in that country or my country would say that I'm entitled to do something. There is no infringement, but still the court takes a different view. Tax authority takes a different view without the court having decided the matter. And you may find that there may be a disallowance. When it comes to cryptocurrency, what we talk is whether it is legal or not legal. What are we concerned? Let us tax it. Why not apply some such logic also when it comes to the expenditure side? But that's where we are on the amendment which has been made. Another facet of this amendment is that a doctor is receiving a payment. For a doctor, this can be considered to be a benefit or a perquisite which is receiving in the exercise of his business or profession. Section 28, subsection Roman 4, says that such benefit or perquisite would be a taxable amount. Today, there is no check on such benefit or perquisite received by professionals, the chartered accountants being included. But here, in case of a doctor, amount is not reported. To keep a tab on that, what we are now told is that anyone making a payment, while in his assessment, it may not be a deductible expenditure, but while making or granting the benefit, he must deduct tax at source on the value of benefit or perquisite at the rate of, I think, 10% of the amount. Now, what we find here is that somebody has to take a view. What is the benefit or perquisite? And when there are common expenses on a group of people, but I have to issue a tax deduction certificate to each of them, what is the value of benefit in individual hand would be something mind-boggling. Maybe the court will come up and say that with regard to such expenses, there is an impossibility of performance. The next amendment is an amendment which I would not have liked to say in my professional career. Cash credit or borrowings taxability under section 68. This I consider to be the most unfortunate amendment of this particular finance bill. An amendment which I believe has put us back by 4 to 5 decades in the sense of evolution of a revenue law. And this amendment has now been made at a time when we have a highly regulated economy. We have complete interaction of the tax department with many other departments of the revenue, not only in India, but across India. When we have developed technology, when we have a portal of the tax authority, which is an enviable portal, where information is available on the backdrop, Google will come up and tell you at times that these loans are bogus loans. But we now want to make an amendment in order to capture the loans and advances, and what a phenomenal impact that it can have. Before we enter the debate, let us all remember that an addition by way of a loan which is made under Section 68 has to be read with Section 115 BBE, according to which tax will be payable at the rate of 60% of the loan amount, because it is that loan amount which is taxed as income. Together with applicable surcharge, tax liability will be 78%. Together with penalty which is leviable under Section 271 AAC, payability will be 84% of the loan amount. Imagine a situation, and mark my words, after 5-10 years, it would not be a theoretical discussion. Imagine that, say, Mr. Abhay Mehta is a lender and I am a borrower. I borrow the amount from him for a month and return it back, because 84% payability to income tax authority is apart from my liability to repay the loan to the lender. There are 12 people in a year who have taken temporary advance or temporary loan for a month from Mr. Abhay Mehta, and some difficulty has arisen with regard to evidence to be obtained from Abhay Mehta or with regard to credentials of Abhay Mehta. It's not personal, I'm just taking him as an illustration. Then in 12 different assessments of 1 year, because money is fungible, money keeps on rotating, each of the borrowers from Mr. Abhay Mehta during that year will be accountable to tax liability of 84%. This would be one day a practice and not a theory. So this is an extremely sensitive amendment which is being made. Now, what was the provision? And it has been a provision since the days we qualified in our CA. And there were the days when there used to be an appeal where Section 68 would be a common point in any appeal that you go. For us, it was bread and butter during those days. It will again become bread and butter for everyone, because it would be a rich harvest of litigation which is being created through this particular amendment. I don't know the compulsion of the tax authority. There could be 100 cases in the country where tax authority may be very keen to apply the provision, but is it therefore the necessity to probably capture it in such a vast manner? What was the provision which is there even today? The provision is nature and source of borrowing has to be explained by me being the borrower, a fair provision. Series of Supreme Court decisions took a view. I have to prove identity of the lender, genuineness of the transaction, and creditworthiness of the lender. If these things are done, and these are very vital things, it covers everything which is governing the credentials of a cash credit. Then don't go into the source of the source. There are some exceptions where the courts themselves say that. However, if loans are from related parties, then in that case, one can have a latitude to go into the source of the source. We are also told by way of a specific provision today that if there are share application money, share capital money, etc., then in some cases, what we find is source of the source may be investigated. Now, what more do we want? But no, on the top of that, we are now told that unless and until the lender has explained nature and source in the hands of the lender, and that explanation has to come from the lender. Until that is done, no matter what I say to the assessing officer, explanation will not be regarded as satisfactory to the assessing officer. Now, why do we need something coming necessarily from the lender? He has to explain to me the source as well. I know for certain that Mr. Abhay Mehta, the lender, is far more prosperous compared to the loan amount. Is that not sufficient? But no, I have now to ask him clinically that please tell me how you accumulated this amount, what are your sources of income, how you gathered this money, and you came back to the fund which you are raising. This is what will happen on the field. And that's why we need to be extremely careful. And what is the amendment? Even if I borrow from the bank, I will have to go to the bank and say that, kindly give me the source of funds which you have. I imagine when I go to the bank and deposit some amount, and there are certain cases where in certain sections like 269 SS and 269T, the debate is still on whether a deposit is a loan or is not a loan. Now, if somebody in the assessment of a banker were to say that deposit is a loan, if not a loan, at least it is something of a nature similar to loan, because the section says loan, borrowing, or such other amount, then a banker will be under compulsion to explain in the assessment from each of the depositor from where depositor accumulated the fund. PSU will be also required probably to explain all this. So there is a serious need for reconsideration of this particular provision in my humble view. Let us now come to the next one, taxability of digital assets. Virtual digital asset. Many digital assets have developed in the recent years. We have cryptocurrencies. They are developed today on blockchain technology, cryptography. There could be some other platforms which may come up tomorrow. We have non-fungible tokens, the NFTs. Some of them could be even in the nature of work of art. We can't discount that. All of them may appear to be valuable. They store value. One can exchange value. One can trade value. There is a market for it. And therefore, even if there is no provision in law today, it's not as if that transactions in digital assets can be considered as immune to tax. Bigger dispute is on legality. But tax authority, finance minister, I think at least the tax authority in public platform has mentioned that we are not concerned with legality. That's a separate subject. We are here concerned with taxability. So to begin with, to my mind, I think it was not necessary to provide for a separate stream of tax provisions for the digital assets. But let's suppose that there is a separate stream which has been developed. Then we'll examine the fairness of the stream. What we are told is that if there is a transfer of any digital asset, and transfer could include any form of transfer, if it is a capital asset, section 2, subsection 47, transfer will apply. If somebody says, no, it's not a capital asset, then the meaning of transfer could be a different meaning. Let's take everyday meaning, a sale of a digital asset. You may be holding by way of stock in trade, capital asset, whatever. And if you sell on the gain, surplus will be considered to be taxable. at the rate of 30% plus surcharge. A person who earns income, he is told that yes, we'll tax you at the maximum rate, but except for the cost of acquisition, we will not give you deduction in respect of any other expenditure. There could be legitimate expenses. Market knows on an exchange if I want to transfer something, and if a commission of 5 to 7% is payable, it's a legitimate expenditure, but we are told, no, we will not allow that expenditure. Third, if any loss is incurred from a transaction, it will not be allowed to be set off against any other type of income, fair enough. It will not be allowed to be carried forward as well. So this is a silo which is created, which is worse than a silo of speculative transaction, something which is developed, at least innovation is involved, but we are putting this at par with speculation and gambling, and we say that it will worse than that, it will not even be allowed to be adjusted against income of such a type, if at all arising at a future date. If I've incurred losses in another activities, it will not be allowed to be set off either. And if I'm receiving by way of a gift, then the market value thereof will be considered to be taxable amount, which again is fair. But creation of a silo where even interchangeable loss and gain is not being allowed is probably, I think, but there could be a different view, going a little far. Not allowance of expenditure, even if it is genuine, is going a little more far. And I'm worried because if otherwise it appears to be in the nature of comparable to a transaction with any other property, it could be a digital property, there should not tomorrow some challenge coming up from legal fraternity that we are creating a discrimination as between two assessees, one of them dealing with a tangible property and another dealing with a digital property. What is the difference so far as taxability is concerned between these two forms? You can say that expenditure, if it is not genuine to be disallowed, automatically it will be disallowed, but we are going a little further on that. The next amendment which we have is dividend income from a foreign company. Section 115 BBD. An Indian domestic company receiving dividend from a foreign company, today there is a concession that it could be taxed at the rate of 15%, but really it may not be a concession in all cases. There is a trade-off that an expenditure which is incurred by me is not to be allowed in computation of dividend income. Now we are told, and I think rightly so, that this provision was introduced at a time when in the hands of shareholders, dividend was not taxable. There was a DDT regime. With transition to the classical method of taxing dividend, why not also tax dividend income in the hands of a domestic company? So now when we have a foreign subsidiary paying dividend or a foreign associate paying dividend, then from 1st April 22 onwards, dividend will be taxable at full rate. If someone is interested in securing a concession, dividend will need to be pulled by 31st of March 22. But there are many Indian companies where they may find that Section 80M may make it neutral for them whether dividend is received today or tomorrow, all such companies may be agnostic to an examination whether dividend should be pulled before March or is to be received after March. In fact, in some of the cases where we may find that pulling dividend after March during the Pillar 2 regime might be a better proposition if dividend is coming over from certain tax-free jurisdictions, because then the tax paid on dividend income can be attributed to the jurisdiction of the dividend paying company. Now, with dividend coming in and becoming taxable, the limitation of expenses not being deductible goes away, the embargo goes away. So whatever I can deduct under Section 57, though unfortunately, that also is now very truncated and limited. But say, for example, 20% of the interest expenditure which I have incurred, 20% of the dividend income, sorry, not 20% of interest expense, but interest expenditure up to maximum 20% of dividend income will be considered to be deductible expenditure. That takes us to the next topic, and that is faceless assessment scheme. Country has gone quite far away in the implementation of faceless assessment scheme, and the tax authority is quite emphatic in making it a success, and why not? I think they are entitled to do it. Now, one of the bothersome issues which had arisen in the implementation of faceless scheme was whether any scheme which provides for or which denies, which has a provision which denies opportunity of being heard in person by an assessee can be considered as being against the principles of natural justice, and whether therefore any assessment order which is passed may fail the test of compliance with principles of natural justice. We must remember, and this is not because I want to make out some case, but this is because there is a literature which is very, very rich over the centuries that principle of natural justice, adherence to that principle is a very wide and a vital area. And the courts are always very jealous in protecting adherence to the principles of natural justice. Therefore, when in the context of faceless assessment scheme, question arose before the Delhi High Court. In the case of Bharat Aluminium, the Delhi High Court lamented that it would be very necessary to provide for adherence to natural justice and provide an opportunity of being heard. The scheme is therefore now getting corrected through the amendment, and I think rightly so. We are now told that if there is a stage at which in an assessment procedure, if tax authority comes to a stage where it is proposing a variation to the income which I have returned, and I think that's a stage where prejudice is likely to arise in my hand, then they will have to take care to provide an opportunity of being heard to me. I am entitled thereupon to make oral submissions. I repeat, oral submissions apart from the written submissions. Only thing which is provided is that it will be on a video conferencing basis and not a physical interaction. I don't know how the legal fraternity will look at it, but to me it looks fine that so long as connectivity is on video which is active and it is not on an anonymity, it should, to my mind, but I am a small fry to say anything on that, but to my mind, it complies with the requirement of principle of natural justice. But let's consider whether this can lead to any further complication tomorrow. Now, what could be the complication? Supposing on the video conferencing, I am heard by Mr. ABC, who projects himself as an assessing officer in the assessing unit, which is assessing me. I am heard by ABC, but I am not heard by other gentlemen in that dynamic assessment unit. Now, supposing my order is to be framed by XYZ, who in a dynamic jurisdiction may be holding a charge over me, he has not heard me, and I am not sure, and I have full apprehension that the court will come back and say that no one other than the person who has heard me is entitled to pass an order of assessment. Difficulty can arise. Why do I say this? Because when a brief is given by ABC to XYZ, he has to necessarily brief XYZ and say that, look, these are the submissions which are made, which are in writing. They are there on the portal. You may kindly have a view on the same. Secondly, oral submissions are made before me. So unless those submissions are recorded and a recorded version is available to XYZ, I have not been heard by XYZ. Opportunity has not been given. Supposing there is a review unit which is to look at the matter, and here again ABC will have to approach the review unit, and if he has to explain to review unit what are the submissions which are made by me, then in that case, point will become as relevant also in the context of a review which has been carried out by the review unit. But let legal fraternity take care of this. Let the legal acumen of the tax authority take care of it. These are the apprehensions which I have. The next provision is business reorganization, Section 170 and Section 170, capital A. I'm not sure whether this provision would have been or could have been differently worded as compared to insertion in Section 170, because a reference to Section 170, somebody may come up and argue that only those cases are covered where our business is being carried on and we are concerned with a succession to business by a person who is carrying on business. There could be certain companies which may have a business which is no more carried on, certain companies which are investment companies, and tax authority takes a view they are not in business, then whether placement of a section in Section 170 could have any impact or litigation is a point to be considered. Now let's examine why these changes were necessary. That will help us understand the amendments better. Take a case where there is merger of one company with another, ABC with XYZ. And typically, what we find that in a merger, there will be an appointed date. I file a petition today. Today might be the appointed date, but petition hearing may take more than a year at times, for the court to sanction it from an appointed date. If in a merger or a demerger, a petition is sanctioned, then from the appointed date onwards, income or loss may get shifted to XYZ, the amalgamated or resulting company. But until such time that we find court order is available and court order is communicated to the commissioner, both the companies and the tax authorities will proceed on the basis as if that each of them is a separate company, an independent or a standalone company. So ABC will continue to include the whole of the income. XYZ will not include income, which is to come over from ABC because the scheme is not yet sanctioned. Now, supposing the scheme is sanctioned, then XYZ, the amalgamated or resulting company, will have to revise the return of income to include that portion of the income which, effective from the appointed date, belongs to the resulting company or amalgamated company, but is sitting inside the amalgamating or the demerged company. There was no specific provision in law to provide for revision of the return. Marshall and Company's case, Supreme Court had already cleared, and it reiterated in Dalmia Power's case that you don't need any specific provision. You ought to comply with the mandate of the court order. Forget what the procedure in law is. You must create a procedure by which order of the court will be given effect to. But in any case, it is now provided that the receiving company will be enabled to submit a revised return on the portal in 6 months' time, 6 months from the date of the order of the court. This needs to be done. Now, what happens if it is beyond 6 months is further question which will arise, which today remains unaddressed. Now come over to some difficulty which was arising in case of ABC, the demerged or the amalgamating company, etc. Till such time, the commissioner of amalgamating company will be aware that there has been a court sanction. He will continue to treat the amalgamating company as a separate standalone company. He will issue notices on amalgamating company. He will pass assessment orders in the name of amalgamating company. I am repeating, in the name of amalgamating company. I'm sorry. Now, he may not be aware, officer may not be aware that the court has passed an order of amalgamation. An amalgamating company has been already struck off the register. It has ceased to be a company. Courts had taken a view that if you are passing an order of assessment and serving an order of assessment on a company which is a dead company, then it cannot be considered to be a good assessment. Therefore, there was a need for some provision by which, and fairly so, that actions which are taken in good faith in the dilemma that we have, until the date commissioner becomes aware of the changed circumstances, there should be validity provided to the actions which are taken by the tax authority. I am fine with the changes in terms of the purpose of the change. Probably, the change should have been worded in a manner where it should bring out that the purpose is to validate the actions which are taken by the tax authority. But let us look at the amendment. And this is my fear. On literal reading of the language of the amendment, what do you get? Take the case of a demerged company to understand the language of the amendment. There is a demerged company which has two divisions. One of the divisions is to go to XYZ. Another division will continue with ABC. An order of assessment is passed in the name of demerged company, but part of the income will shift to XYZ. So if a demand is to be raised, then eventually what will happen is that half the demand will pertain to demerged company, half the demand will need to shift to the resulting company because income will get split in the hands of the demerged and the resulting company. Now the amendment language says that, and I am on language part of it because ultimately beyond language, nothing will be seen. No one is immortal to part out and impart that I had imagined it like this and therefore the court should read it like this. So what is the language? That an order of assessment which is made on the demerged company will be deemed to be the order of assessment which is made on the resulting company. So my apprehension is the court may say that by a deeming fiction, entire order which is passed on the demerged company should be deemed it is as if it is passed on the resulting company. So can demerged company say that no order is passed against me, no demand is raised against me, and therefore, as a consequence, because deeming fiction will have to be given full effect, if no order is passed against me, the notice also may fail. Or can the tax authority tell resulting company that you pay the entire tax, including on income of the demerged company, because the order should be deemed to have been passed against you. Greater problem will arise in case of some of the reliefs which are given by IBC companies. So I am fine on the purpose of the change, but in my humble submission, probably the language needs to be fine-tuned to ensure that no consequences which are unpalatable are likely to arise. The next change that we find here is a change on updated return. A highly and a much talked about change. I am not too sure on the extent to which probably the taxpayers may be very tuned to this particular scheme, but well, it's a good facility which has been sought to be extended. And if on a cost-benefit analysis it works out, then the taxpayer will be game for it. In some cases, the taxpayer may have committed an error which is obvious. It might be an unintended error. He may correct it, but he will correct it at a certain cost which he needs to incur. So I will need to pay a penalty also for the honest errors that I made, is a sense which one will get from this particular provision. Now, in brief, what is the provision? What it says as announced is that if I have furnished a return of income, and if I find that there are certain deficiencies or errors which are made in the return of income, or even if I have not filed a return of income, but by and large, there will be the cases where return of income is filed. So let's restrict to a case where return is filed. then within 2 years from the end of the assessment year, I can come up with an updated return. I can insert additional income. I need to follow certain steps. And if I do that, there will be no penalty, there will be no prosecution. Today, we don't find specific insertion to say there will be no penalty and prosecution. But I think on public platforms, we heard people saying that there will be backup provisions to be inserted to guard against vis-a-vis that part of the income, to guard against penalty and prosecution. Now, this is not to be misunderstood as a voluntary disclosure scheme. Certainly not. And I think department also does not intend that, nor does the language of law say that. There are a number of cases in which you find in this highly regulated scheme that an SEC will not be entitled to qualify at all. If there has been a search on me, if there has been a survey on me, if I am caught under the Benami law or under some other criminal law, etc., I cannot fit within this scheme at all. Even with regard to any innocent item, I cannot come in. It's a disqualification that I suffer. Another what I am told is that I cannot come up with an updated return in a case where assessment is pending against me or an assessment has been completed or in my hands in respect of this assessment year. Let's take an example. I am filing a return of income, say in July 22. As soon as I file a return of income, assessment becomes a pendency. And once a pendency, until the pendency has not run out, I cannot file an updated return. Supposing 143 notice is issued against me, in that case, the pendency continues and I cannot come up with an updated return. 143 to return is acted upon. An order of assessment is passed against me. This is a case where an assessment has been completed and therefore for this year, I cannot file an updated return. The section will have no meaning for me in relation to that assessment year. Now, consider a case where I filed a return in July 22. 143.1 intimation is given to me. It's an intimation, which I think popularly tax authority would believe is not an assessment which has been completed. 143.2 notice time has run out. So now I reach a stage where neither assessment is completed nor assessment is pending. And if I want to furnish updated return, I can do it up to March 25. One more complication. Supposing 143.1 adjustment is made, I receive an intimation which is with an adjustment. I'm not picked up for 143.2. In such a case, will I be permitted to file updated return? Because section also says that if a recomputation to income has been made in my case, I don't qualify for updated return scheme. So if an adjustment made to 143.1 intimation is considered to be in the nature of recomputation, again, despite the fact that I am not picked up for 143.2, I will not be entitled to furnish a return of income. Now let's assume and come out. Let's assume I am a qualifying person. I filed a return of income in July 22 I find that I have missed out how the scheme will operate. I find that interest income of 1 lakh is omitted to be taken. On examining AS 26, AS, or on examining some of the records, I find I have missed it out and I want to correct the error. So I file an updated return within the qualifying time. I will have to pay the tax and I will have to pay applicable interest. Supposing tax comes to 30,000, interest comes to 5,000, I will have to deposit 35,000. In addition to that, I have to pay additional tax. For a man, in common parlance, this will be nothing but in the nature of a penalty. So proceed on the basis you are paying a penalty. What is the penalty or additional tax? If I have revised my return, updated my portfolio within 1 year from the end of the assessment year, then it will be 50% of 30,000 the base tax. So I pay 15,000 extra. If I noticed an error beyond 1 month, on principles, in terms of innocence, I am the same person. But I noticed it on 1st of April next year, communication came in later, and I update my portfolio within 2 years, then I pay additional tax, which is, it was 25% earlier, and it is 50% in a case where I'm updating. So if I file within 1 year, I pay 7,500 of additional tax. And if I revise beyond March 24, but before March 25, then it would be 50% of 30,000, which is 15,000 rupees. Sorry for the mess. It is 25 and 50%. Now that takes me to the last of the amendment that probably we can take up today, or maybe one more. So the next one is concerning the charitable trust. There are a number of amendments to charitable trust, some in the positive category, some in not so positive category, but we will be concentrating only on one amendment, an amendment which I believe is welcome, salutary amendment in spirit, but then there are certain detailings. One may have a different view, whether this is the way a relaxation may be given, because the reason for relaxation may be different. Reason for relaxation may be concerning also a person who doesn't want to do anything wrong. There is a difference of opinion. And yet, if I have to be bracketed in order to enjoy relaxation on a uniform basis, then one may wonder whether provision could have been implemented differently. But in spirit, it's a good amendment. Amendment to Section 13(1)(c). What was the provision? Where was difficulty arising? And what is sought to be corrected? We are told that in that amendment, in that provision, 13(1)(c), that if a charitable trust incurs certain expenditure which results in a benefit or perquisite, which is unreasonable benefit or perquisite or advantage or cash flow to a connected party, then as per one reading of the current provision, the trust will lose exemption with regard to the entirety of its income. There was a different reading as well, but there was also a plausible reading that a trust will lose exemption on its entirety. Now, there could be certain cases like, say, for example, that some very big size trust has appointed an executive as an employee of the trust and is paid, say, remuneration of rupees 10 lakhs per month. For 12 months, it can come to 1 crore 20 lakhs. He is as such an employee, but since he is the person and in the nature of CEO, instead of inviting him to the trust board meeting, he is taken as a trustee also as the trust. Now, in this case, he becomes a connected person. Assessing officer finds in assessment that remuneration that he deserves is 9 lakhs of rupees per month and not 10 lakhs of rupees per month. There is an unreasonable payment of 1 lakh per month, 12 lakhs per year, which is given to him. What is now sought to be provided, amended, is that in such a case, trust will not lose exemption with regard to the entire income, but exemption will be lost with regard to the unreasonable portion of income. Fair enough. In addition to that, what we are told that the trust will pay a certain penalty. The penalty will be that for the very first year in which such difficulty has arisen and 12 lakhs of rupees is found or alleged to be an extra payment, these are very subjective. I may feel 10 lakhs is correct. I may feel a person was not even a connected party when he was appointed. I may feel he was getting salary more than 10 lakhs earlier, but I may have to go up to the court. I may say, okay, I am fine. 12 lakhs of disallowance is fine with me. But we are told now that in addition to losing exemption with regard to this 12 lakhs, if I read the amount, the amendment correctly, in the first assessment year where default is noticed or unreasonable is noticed, penalty will be, and the way it is worded, sort of automatic penalty of 100% of this unreasonable amount. If I continue to pay salary, and if officer continues to take a view that 12 lakhs is unreasonable, second year onwards, penalty will be 200% of the unreasonable amount which is being paid. Now, firstly, penalty cannot be automatic. No matter whether section 273B is amended or not amended, it appears to be a slip. I think it might be amended. But penalty as such cannot be automatic. Supreme Court in Hindustan Steel case 83 ITR took a view that a penalty cannot be considered to be in the nature of an automatic penalty. So this is one change on section 13(1)(c), a change which in spirit good, but in implementation, I am very doubtful whether it should be such. At the most, you can say that in those cases where it appears that unreasonable amount is figured consciously or on a deliberate basis, you might visit a person with a penalty, which again is an appealable penalty. The next change is on section 13(1)(d). We are told today that if a trust were to make any investment in the shares of any company, including Section 8 company, then in that case, entirety of income of the trust may come up for taxation. Exemption under Section 11 may be lost. 12 also may be lost. with regard to corpus, etc. There again are two views, whether entire income or only dividend income coming up from the investment. We don't get into that. Let's assume, which is plausible, say the entire income. Now, this was creating a lot of difficulty. Firstly, with regard to investment in Section 8 company, I think probably the law itself should have been amended to make it 11(5) compliant, that it's a tolerable investment. Nothing further may need to be seen. But here, difficulty was arising that government undertakes a number of projects which government is insisting must be implemented through the medium of Section 8 company if government is joining a charitable trust and the project is being implemented jointly. So there is a sort of compulsion on the part of a trust to become a shareholder in a company, which would have created difficulty. So keeping that in mind, or otherwise whatever, we are now told that when there is an investment which is made, the amount invested will not be considered as an exempt amount I'm sorry. To that extent, income will not be excluded. This is quite good enough. The language is not very clear on whether I am required to divest myself sorry, whether I am required to divest myself. If I don't divest, whether exemption will be lost in all subsequent years, or whether in all subsequent years, the investment value of the shares will come up for additional taxation. There is no provision for a penalty like we have in case of Section 13(1)(c). So here also, I think language and the provision may have to be taken care of to spell out exactly what the intent with regard to 13(1)(c) and 13(1)(d). Our prayer would be make it workable in the interest of the charitable trust. There could be some mischievous elements, but the charitable trusts are doing an excellent job. And if in spirit they could be relieved of certain hardships, it would be extremely welcome. Now, as I mentioned, we will not be able to cover up all the amendments, and permit me maybe to stop the discussion because there could be 10 more amendments one can go on with. So at the end of the analysis, what do we get? Intent of any law is to look at certainty of law. Compared to the presentation of the bill a day before and day after, are we proceeding towards certainty, or are we proceeding towards a bit of ambiguity and uncertainty. Reduction in litigation, a day before and day after, are we giving scope for more litigation or are we ending the litigation? To me, the answers seem to be that a number of amendments, it's difficult now to cope up with the length of amendment. We have come to stages where even in 1.5 hour of a lecture, we are not able to cover half the amendments which have been made. If that is the state at which amendments are made, we need to be a little more careful. Compliance is becoming more and more difficult along with the amendments which are made. If nothing else, some credit may be granted to the bona fides on the ground that the provisions are becoming so complex that it is difficult even for acknowledged experts to be able to give correct answer at times. So if nothing else, when it comes to a penalty or prosecution, let those provisions smoothen out in a manner that only when there is a conscious, guilty, or a deliberate mind that one could be visited with certain consequences. Let there be no deeming provisions which operate with regard to penalty or prosecutions or the like. They may be taken more seriously. Amendment may be how to see to it that no wrong person comes in, rather than to look at that basket of defaulters is becoming larger. I think I'm saying that on behalf of not myself, but the community at large, at the end of the experiences which we have, acting innocently, bona fide, and in sincere manner as professionals. Thank you very much. Yeah, fine. Over to you. Sorry for some interruptions here.
No, it was a masterly analysis. And we came on the screen just because you were feeling a bit uncomfortable and thought you will not be able to carry on. There was no other intention to stop the lecture.
No, not at all. Yeah.
And Pinakin bhai, this was the day when you made me a bit prosperous monetarily by giving my example. But let me say, the prosperity of knowledge which you have carried will be substantially low than what you would have given me the prosperity in wealth. Your in-depth analysis and perspectives to various amendments, which due to typical drafting may involve numerous litigations going forward, have been highlighted, like digital assets, section 170-70A, related restructuring, section 43B, section 68, section 194R, to name a few. Analysis was beyond the dissection of the sections and providing insights of what will be in store going forward by analyzing each such section from business and legal perspective. We are really thankful to you, Pinakin bhai, and I will request Kinjal Shah to propose a well-deserved vote of thanks. Kinjal, you are mute.
Is it audible properly now?
Yes.
Friends, let me first start with the announcement of the forthcoming programs. The flagship event of BCS, that is the 55th RRC, will be held at Nashik from 24th to 27th February, and it will be covering various contemporary topics by galaxy of renowned faculties. However, due to overwhelming response, the physical registrations are closed as of now, and few seats are left for online mode. We request member to register for the online RRC at the earliest. A panel discussion on the budget 2022 covering the economy, taxation, and capital markets has been organized on 22nd February, and the panelists for the program are Mr. Soumya Ghosh, CA Sharik Contractor, Mr. Devin Choksi, and the meeting would be moderated by Sonal Putra. A lecture meeting on Build Your Own Risk Consulting Practice on 11th February 2022 by Mr. Rama Warrior and CA Harsh Shah has been organized. 22nd DTAA course from 20th February to 20th March 2022 and a Forensic Accounting and Investigation Study course is organized from 1st of April 2021 to 31st March 2022. I request all the members to take advantage of these programs organized by BCS, and all those who have attended in the past have found it to be very enriching, and I will again request members to enroll for the courses and the programs. Let me now have the honors of proposing a well-deserved vote of thanks to Shri Pinakin Bhai Desai. Pinakin Bhai has dealt with one of the most complex law on this earth and has simplified the provisions of the direct tax budget amendment in his all-encompassing budget, a short speech. Friends, initially while hearing the finance minister on the budget, the direct tax provision, many of us had apprehension that what is that we will cover during the budget meeting. But after hearing Pinakin Bhai, I'm sure we have all realized the far-reaching impact of the amendments that have been made in the direct tax provision and the complex nature of those amendments, which are going to have very far-reaching impact. I'm thankful to Pinakin Bhai for sparing his valuable time and addressing the members on the direct tax budget amendments 2022. I, on behalf of the Bombay Chartered Accountant Society and 1,000 plus members who are watching this program live, present a well-deserved vote of thanks and request you all to carry it out with a round of applause for Pinakin Bhai. Friends, I would also be thankful to CA Raj Malik from Reliance Industries Limited and CA Gandharva from the Polycab for the sponsorship from their respective organization. I'm also thankful to FTC Event for their efficient handling of this online event. And once again, Pinakin Bhai, we are very thankful and fortunate to have you on this budget provisions. And at times, we are also of the opinion that it would have been next to impossible for us to understand the complexity of these provisions, the way you handle it lucidly and in a simple manner. So thank you once again on behalf of the Bombay Chartered Accountant Society. Over to you, Abhay Bhai.
Thank you.
We declare the close of the
meeting
meeting.
closed. Yes.
Thank you.
Thank you.